Hi everyone, my name is Jenn-Hui and I'm the Global Head of Stewardship and Sustainable Investing at Fidelity. And I'm here to talk to you today about sustainable investing in China. Two things that a lot of people think don't go well together. And the question we're going to be asking today is, are they compatible? And not to give away the punchline, but I think the answer is going to be that if you're a sustainable investor and you're an investor looking to make progress and impact on many of the important themes behind sustainable investing, then really there is no more important market to do that than in China. But before we get into the details, I want to just lay out a little bit of scene setting. So this first question is based from our analyst pulse surveys, and it asks the question to our analysts: have you seen a growing emphasis among your companies to implement and communicate ESG policies? And on the left-hand side, you can see the global aggregate number, and you can see the very strong step change in interest from companies all around the world in talking about their ESG approach. But then on the right-hand side, you can see how that breaks down by different geographies. And actually, you can see that the interest in ESG from the companies that we invest in goes right across the world. It is not just concentrated in any one particular market. And if you look specifically at China, you'll see actually some of the greatest changes in responses from the companies. So from as little as 33% 2 years ago to now more than 80% of our analysts saying that Chinese companies are paying attention to ESG risks and opportunities. And we're going to be examining a few of those reasons why they might be doing that in this session. And the last bit of scene setting, China as it is important to the global macroeconomic conditions. The IMF estimates that over the next 5 years, China will contribute just under 30% of the expected global growth. Now, of course, these tables and stats were run before the pandemic, but if anything, China post-pandemic, China will probably now even have an even greater impact, given that its recovery from the pandemic, being the first in and now the first out, is probably the greatest. And together, China and India will, in the next 5 years, overtake the United States as the primary driver of growth for our economy. But how does China look like from a sustainable investment perspective? So these are charts using MSCI. Chart on the left-hand side shows you the percentage of companies that are rated BBB and above in each region. And as you can see, Europe leads the way. More than 90% of companies in Europe are rated BBB or above. And in Asia Pacific lags the rest of the world. And then if you look at the breakdown within Asia Pacific ex-Japan, again, you get a very broad spectrum. So from Australia right at the very top with developed market standards to China and the Philippines at the bottom. So why is that? Is that fair? And how is that changing? So there are some risks associated with investing in Asia, the emerging markets, and in China in particular. And these are risks that are well known to investors and risks that fundamental bottom-up investors ought to pay a lot of attention to. So issues like the fact that most companies in MSCI China have a controlling shareholder. And so you need to carefully evaluate the quality of that controlling shareholder and whether they will genuinely run that business in a long-term way. We look at issues of board composition, as we do in any other market. We look at issues of capital allocation, balance sheets that perhaps have too much cash, that are using that cash for spending on non-core purposes. We look at related party transactions. A lot of companies within Asia have relationships to each other, both at a shareholder level and then also at a business level. And these related party transactions, whilst they may be perfectly innocuous, can also present opportunities for the extraction of private gain at the expense of public shareholders. And so we want to keep a close eye out for that as well. And finally, on audit equality, we want to make sure that, that financial statements are audited correctly and properly and avoid issues around corporate fraud. So I'm going to turn the first part of this discussion to probably the most eye-catching of China's recent proposals, the announcement made by President Xi at the recent UN General Assembly in September that China would achieve carbon neutrality by 2060. What does that mean, both for China and for the world? I think the first thing to say is to acknowledge that this goal is incredibly ambitious. Yes, it is 10 years later than the European ambition or the ambition in other developed markets. But actually measured by the length of time between China peaking its carbon emissions, which it says it aims to do by 2030, and the time it will achieve zero on those emissions or net zero on those emissions, a time of only 30 years, that actually compares quite favorably versus many of the other developed markets. So this is an ambitious pledge that, if implemented, will have significant consequences both on global temperatures, but also on the world's energy markets, on agricultural markets, on industrial markets. And will China achieve this goal? Well, I think the first thing to say is that China does have strong incentives to achieve this goal. So climate change for China, as it is for every other country on Earth, is a grave economic and social risk. And many parts of China are exposed to the risk of flooding, being in low-lying areas. And these issues can cause significant economic damage. So China has as much of a vested interest in addressing climate change as any other nation. But then, if you look at the sort of geopolitical situation as well, you can see that actually, if China were to achieve net zero through the reduction of reliance on its fossil fuel consumption, that would actually improve China's energy security by reducing its dependence on the import of fossil fuel, particularly that of oil and gas. And if you look at the rise in border tariffs, in carbon pricing in different markets and associated border tariffs by markets like the EU, you can see that China stands to lose a lot as one of the world's largest net exporters if these tariffs were to be imposed. And so actually reducing the carbon content of Chinese produced goods will also improve China's competitiveness when it comes to being and continuing to be one of the world's leading exporters of goods. And then finally, if you look at China's record when it comes to climate pledges, China's actually made 3 pledges in the past. This is its 3rd. China is on track to accomplish its earlier 2 pledges around achieving greater carbon efficiency and around setting absolute levels of carbon targets. And so this isn't something that China just announces and then doesn't do. There is a track record here of having successfully delivered achievement against climate goals in the past. And then looking now to the rise of ESG within the Chinese domestic investment industry. So you can see that as China capital markets open to international investors, its A-share market opens, you can see that China is benefiting from many more international investors coming and bringing with them the international responsible and sustainable investment practices that we see elsewhere around the world. And at the same time, you see significant uptake, albeit from a low base, of Chinese domestic asset owners and asset managers becoming signatories to the PRI themselves. So at a ground level, you can see that growing interest, the growing influence of ESG issues within the Chinese domestic capital markets. And within China's consumer markets, Chinese consumer preferences are changing very quickly as well. Its middle class is growing very rapidly, incomes are rising, and the urbanization rate is also rising very fast, also from a low base. All of these changing consumer preferences is driving changes in Chinese corporate behavior. They too now have strong reputations and brands that they need to address, they need to be concerned about. If scandals were to erupt of an ESG nature, that could cause a consumer backlash and cause these companies to lose market share. So as with other markets around the world, having a strong ESG reputation, having a strong control over the risks that ESG can bring to a business, these are now as important for Chinese businesses as they are for international businesses as well. And I think you can see signs of early improvement already. So I showed you earlier the chart that shows how China is ranked using MSCI data. And we show this now comparing MSCI China to MSCI emerging markets and then MSCI all world as well. But then this chart also shows you the rate of change, and even over 1 year from 2018 to 2019, you can see directionally things are improving. The number of companies rated CCC has declined slightly. The number of companies rated BB has improved slightly as well. And so we expect this trend to continue directionally as Chinese disclosure gets better and as Chinese ESG practices get better. We expect China's ESG ratings to start to move up the curve. And we expect the alpha that we can capture from that improvement in the ESG ratings to accrue to the investors who are invested today in the Chinese markets. And as investors, we aren't simply passive observers of the improvement in Chinese company behavior. We can work actively with them as well, to engage with them, to drive that improvement, to educate Chinese companies on what it is that global institutional investors look for and how they best are able to provide that kind of information. And so how would you go about practicing sustainable investing in China? I think we would bucket this into three big topics that we've talked about. So firstly, corporate governance is a key investment risk in these markets, and therefore any analysis needs to be built on an understanding of the company's track record and its management quality. Secondly, that looking at third-party ratings alone isn't going to get you there. Yes, it's an important measure, but largely it measures disclosure, not the actual underlying practices on the ground, which may be moving so quickly within China that they're not being picked up in a timely way by those providers. And thirdly is that in our experience, most companies in China do welcome conversations with ESG from their investors. They're interested to know what their shareholders have to say to them about these practices. And in turn, engaging with these companies allows investors deeper insight and the ability to change their behaviors for the better. But all of this is only enabled with fundamental analysis of the companies themselves. As I mentioned, third-party data tends to adopt a relatively standardized data-based approach, and this can lead in some cases to misleading results for individual companies. And so it's important when we think about investing in China at Fidelity to carry out deep dive analysis, regularly communicating with our managers and conducting upstream and downstream channel checks to ensure that what they're telling us is in fact the case. It is our belief that good sustainability practices will lower the cost of capital for the company's business over time, and that fundamental analysis is key to discovering some of these undiscovered issues. And this is an example of the kinds of engagements that can lead to the accrual of investor value. So on capital allocation practices, I mentioned earlier that a lot of Chinese companies don't have strong capital allocation practices. They can have quite inefficient balance sheets, and they don't think about the dividends that they pay out to shareholders. But educating Chinese companies on the benefits of capital allocation, the benefits of superior balance sheet practices, letting them think about this issue not as being simply about the preservation of cash, but about how actually it can be a disciplined part of the way in which they manage their overall capital budgeting and their governance around new investments that can drive greater shareholder value and improve their company and improve returns for shareholders as well. And companies on the right are some of the examples where we've successfully had that dialogue with those companies and seen those improvements come through. But it isn't obviously only about improving shareholder value. We also need to make sure that we're tackling the larger E and S issues as well. So Fidelity is a member of Climate Action 100+, and through Climate Action 100+, we're leading the engagement, we're co-leading, I should say, in partnership with other participants in the industry on a number of engagements with leading Chinese state-owned enterprises. So most notably PetroChina and Sinopec, and we're also participating in two more in China, China Jenn-Hui and CNOOC as well. And through this collaboration, we feel that we can make much more of an impact in addressing the overall aggregate level of carbon emissions within the world. And this is an example of one such engagement of PetroChina, which we started in 2019. We planned a sequence of meetings with them. We set out a series of key priorities that we intended to achieve, including improving the climate change governance, promoting disclosure of Scope 1 and Scope 2 emissions, and setting medium-term targets for their reduction. Through 2020, we've already seen very positive outcomes from this. So they've disclosed their Scope 1 and Scope 2 greenhouse gas emissions for the first time in their ESG report. They've committed to increasing their investment in renewable energy and natural gas. And most excitingly of all, in August, they announced a near net zero 2050 target, which represents the first public statement of a carbon neutral pledge by a Chinese SOE, which of course underpins the pledge at that national level.